Hi everyone, welcome to the channel Dominate My DCF, and I'm Lakshya Chhabra and I'll be your host, and today we are going to discuss Hikal Limited. So let's just begin with it. So this is a short note I prepared on Hikal Limited, and so let's go. So about the company has three business divisions. The first one is the pharmaceutical, the other one is animal health, and then we have the crop protection. The pharmaceutical, including animal health, makes up 60% of the revenues, and the crop protection business makes up 40% of the revenue. So currently the animal health is kind of very small part of the total revenues, and the pharmaceutical business and crop protection can further be divided into two subcategories. So they have their own products in the form of generic APIs, and then they have their CDMO. So to understand these two divisions in a simpler way, assume the own products being generic APIs being more of a commoditized in nature, low gross margin, and lower entry barrier business, and potentially no barriers to entry. So the CDMO, on the other hand, is a very good quality business, although lumpy cash flows, but it's a very good quality, sticky business, and you have better competitive advantages in this kind of business if you are doing it for an innovator. So basically, what CDMO is you have a big pharma company in US, let's just say a Merck. So they go on to produce a new drug. So they will need to partner up with some manufacturing unit in India or in China or in US. So for the manufacturing of that molecule, and so the development is in phases, as you can recall from the vaccine times during COVID. So these are in three phases: phase one, phase two, phase three, and then you launch the drug. So that would happen, and this is basically the CDMO business where you help the innovator or the research company to manufacture their drug and scale it up. So basically, manufacturing and scaling up that drug is a difficult part. So that is why this this business division commands a very higher gross margin and it's a very sticky business, and it's a good business to be in. But it does have a lot of upfront investments and a very high operating leverage, which is a positive thing and a negative as well. Now let's just move on to the positives of the business. The company has a very clean track record, primarily being the CDMO business. So they have zero USFDA observations, and so regulatory checks, they are very clean. Now moving on to the outlook. So pharmaceutical business is currently recovering. So basically, from a downtrend, moving into a good uh, path, and animal health is in a healthy phase, and crop protection is facing subdued demand globally and headwinds. So basically, the agrochemical section is facing headwinds globally, and other firms are also experiencing the same. So let's just move on to the triggers in the company, and that is basically the most important part. So the first trigger is the API business to perform well in the second half of the FY25. So as I mentioned, the pharmaceutical business is in a recovery phase. So that is just translated into this thing. Moving on, they have a 10-year. So this is basically probably the generic CDMO or your own products kind of thing. So this is a good news, but not much of a good news, but still a very good news. So this is the part, these two headlines are the part of that CDMO business, basically the higher margin, C clientele, better business, that thing. So in the second part, uh, the business, they have a animal health 10-year contract with a big innovator. So the supplies were supposed to be started in FY24, and but they got delayed somehow. But now they are starting. They're expected to ramp up in Q4 FY25. So 6 to 8 products were expected to be validated. 5 have already been, and then they have set up a multi-purpose facility in Panoli, 140 crores of apex, 1.5x asset turns translate into 210 crores of revenue, but the management has guided for 300 to 400 crore revenue potential in the next 3 to 4 years. Now, the third, the much bigger one, is the two key starting materials. So the CDMO, which they are doing for some innovator, the molecules are under phase three. So phase three is a much promising phase from where you have high chances to move into the commercialization phase. And commercialization is where the drug hits into the market. So they have a patent. The researcher has a patent. So uh, no other competitor can get into it or make that drug because they have a patent. So all the manufacturing can be enjoyed by two or three suppliers, and Hikal will be among them. So these molecules are anticipated to start ramping up by 2027. So if it commercializes, so it will probably by 2027, we have to just track it if it goes into that commercialization phase, can be substantially big for the company. So here's a statement made by the management regarding the same. Going forward, because they are in clinical stage, it's very difficult to predict how they will scale up, but our customers are very confident that we will make it up to the market, and this will definitely be a big one for us, big products for us. This was said in Q2 FY24 management con call. Now let's just look some more optionalities. So optionalities are basically which are not very certain, although these are also not very certain, but still much more certain than these ones. But if it happens, it can be potentially a good thing for the company. So agrochemical multipurpose facility. So the company during August 2021, when the agrochemical industry was doing great, so the company set up 300 crores capex, set up a 300 crore facility. But as and when they set it up, the agrochem industry started to face headwinds, and the facility couldn't be properly utilized. So they have the capacity, it's operational, but they don't have enough demand for it. So with the revival of the demand anytime in the future, the company is sitting on huge operating leverage. Because what happens in pharma businesses or some good quality agrochemical businesses, that they have to put up investments first. They have to place a plant first, and they have to keep it running in good condition, even though they don't have enough demand. So this adds up to uh, this hits the profit and loss statement. So the depreciation hits and whatnot. So when the demand comes back, so they are sitting on a fixed cost, and operating leverage will definitely gonna kick in. So even if they are able to do an asset turn of around, let's just say 1x, it translates into a 300 crore revenue. So the statement demonstrating this was that 3 to 4 CDMO under crop protection expected to ramp up in second half next financial year. That is half two of financial year 25. Sorry, potential revenue being 400 crores. This was said in FY 2022 when demand was high in agrochem, but after demand went off and destocking started. But this is demonstrates the pipeline the company has and the potential here and perform, like they can perform basically. So an optionality. So moving on, the second thing is that might be an optionality, might not, due to my limitations of understanding pharma industry very thoroughly. I have just included it, but I also couldn't understand it very precisely. So the company is expanding into anti-diabetic portfolio and wants to become a major player in this therapeutic segment. So the company has an approach of being in a limited molecules, but scaling it up so big so that they become a global leader in that molecule types. So they have gabapentin, they have TH something molecule. So they are generic global leaders in that thing. So this is a good thing. So the focus of the company is to be in the anti-diabetic portfolio and to tap new geographies. It has 8 to 9 products in pipeline, and they're gonna plan to file 2 to 3 DMFs annually. So DMS is basically the drug application you need to file uh, to the regulator to obtain the license for manufacturing that product. That's what I think so. So here's a statement: we received Taiwanese approval for our API, blah blah blah. This strengthens our position as a pure play API manufacturer and commitments toward portfolio in anti-diabetic therapeutic category. And we have a robust pipeline related to 10 products under development and have targeted to launch 3 to 4 products. Now, this is how the share price history looks like. So to explain this, I have divided into 3 phases. So that's the phase one, phase two, that's the B, and the phase three. I'll probably use a pen. Yeah. So let's just discuss with the phase one. So the share price went up furiously here. So what happened was post-COVID, there were logistical issues. China was the epicenter. So since everybody knows that China is the major player in pharmaceutical and agrochemicals, so there was supply chain disruption, and India was the one which stand to benefit, which stood to benefit. So the customers did a lot of stocking up. So they build up a very large amount of inventory just because they were uh, risking that the supply chain won't recover as quick. So the margins and revenue went up for these Indian companies. So we pharmaceutical and agro. They started to get new and new contracts in the CDMOs and everything. So the revenues both went up, positive news flows all around. So the chemical industry as a whole benefited from it. So all due to pent-up demand, company was trading at 8x price to book and even acquires allocated more than 5% of its equity portfolio here. So here you can see the revenue and the EBITDA margins for the company. So both are rising, both are rising. And so now moving on to phase B and C. So there was an incident that happened in the company. So this incident happened at Sachin GIDC Surat on January 6th, which unfortunately led to a death of 6 people and around 23 hospitalized due to formation of some toxic product at the chemical dumping site. So what happened was it was alleged that uh, the Hikal's tanker left for dumping site and dumped it there, which led to this incident. So Hikal appointed some Sangam firm for the waste treatment and disposal, but turns out that those guys didn't even have the license from MPC, the pollution board, to dump the waste. This was a very poor scrutiny at Heikel's end, so many investors thought that the management should have done this bare minimum thing because you being a uh, very uh, regulatory stringent company and you are not even doing these basics also. So in this incident, the management was arrested by the police. This made many investors doubt about Heikel's management, and this was not the first time investors doubted Heikel's management. Earlier, there was a plant closure due to flooding, and management didn't even inform the public. So, uh, generally, the management has to inform the public via exchange through a corporate announcement that this or this plant has been closed, but the management didn't do so. So that's poor disclosures. So there's a YouTube video on this thing by a value educator. If you want to understand more on this incident, I have shared the link. Also, I'll be putting this thing, my note, in the description below, so you can download it from there. So the plant was ordered to stay closed. The plant contributed over 15% of the revenue. Later, Bombay High Court lifted up the allegation, and the plant was operational by July 2022. Um, Revenue loss of 50 crores doesn't matter. So combined to this, what happened, also led to the fall, was that the channel inventory correction by pharma customers. So earlier there was a thing of piling up inventory. Now the inventory has reached a certain level that the customers don't want to buy at that level. So this led to like destocking in the industry. So the pharma thing started destocking, so there was low demand. Now there was increased depreciation due to asset additions. So as stated above, they have added an agrochemical multipurpose facility and maybe some other investments going on. So increased depreciation was there, and the input cost decreased because most of the raw materials comes from China. I think around 40 to 50% for the company. The cost of raw material went up, solvent prices went up through the roof. Most of the API companies were facing a lot of difficulties and margin pressures during that time, be it Loris or anyone. So the phase three is basically more to the phase B, and along with the ongoing issues in the pharma segment, the crop protection business also went for a toss. So earlier during this phase B time, the pharma business went for a toss, but the agrochem business was doing pretty much okayish, good. But in the phase three, both pharma and now the agrochem were not doing good. So due to global agrochem industry going into slowdown, high inventory stocking, plus China dumping started. So the summary for the phase ABC can be categorized as like phase A was restocking period, phase B is destocking period, coupled with China dumping. So China dumping is basically China having excessive capacities in the following products, and they are just selling it below their cost price. That is by help of subsidies and all, and because of an oversupply situation. So they just gotta sell it. So the company was unable to pass the costs and the margin compressed. The EBITDA margin fell from 21% from in FY 22 quarter one to 6% in quarter two FY 23. So now let's just talk about the things that we need to track in the business, because in our daily life we have to track multiple businesses. So we have to just have to have the key variables that we need to track in a business as a part of our thesis. So the first thing is revenue and EBITDA margins for the obvious. And the second thing is the developments on the two key starting materials, phase three molecules on the pharma side, because this is a very big optionality. So let's just say if the company says that uh, the two key starting materials failed or couldn't pass the phase three trials, then that will be a big negative for the company and might be reasons for a temporary sell off. And the third thing is the animal health contract commercializing. So earlier it got delayed. So the thing needs to be seen as for it to be commercialized and how that thing goes on. API volume uptake, management guided for it. Let's see if can be done. Also, Loris management also guided for the same. So hopefully, like I'm optimistic about it. But let's see what happens. So the Q3 will be a gradual uptick, but Q4 is where the major things will start turning around. Agrochem industry revival, if that happens, that's an added optionality, and that can be a blessing in disguise. Now, let's talk about the valuations. So, such businesses have high volatility in the earnings, hence difficult to value on price to earning basis, hence need to be valued on price to book. So, to like value on price to book. So the peak price to book went to 9x in August 21. Current price to book is 4x. So there have been more additions to the book value in this 3 years. So let's just consider that the company goes to this, achieves this peak value from here. So it's an easy double in 3 years probably, because it's expected that in 3 years the business will start to perform very well. And if this like really commercializes, so I think a price to book of 10 is also possible. And with business performing, so the other peers in the industry like Newland, Syngene, Suvain, they get exceptionally high price to book multiples. So as the CDMO part revenue visibility starts to grow, it's gonna be crazy. So with business performing, I expect the business perception to go up and hence a higher price to book multiple for the business. I expect the business to do well over a course of 3 years only. So that's my reviews only. So I'm just reading it out. Now let's talk about the margin of safety test. This is something which is a back of envelope calculation, nothing complex as such. So I have assumed that the revenue can be 2,700 crores in the next 3 years, coming from 1,800 currently, 300 coming from two pharma intermediates, and 300 crores coming from agrochemical. I believe that in 3 years the cycle might turn around, and 300 from the animal health long-term contract. So I have not even added for the API, the growth in the API business coming in or potential uptick in that. So let's assume the guided EBITDA margin of 18 to 20%. I consider 20% because I think that's an easy thing from here. The resulting EBITDA would come out to be for 540 crores. And then you have the peak EV to EBITDA, which was achieved by the company in August 21 when the business was performing very good. Now, here to understand this thing, what I have done is, uh, so this is basically your output in the here. Output is in the gray, and the input is in the outline orange outline form. So you enter the exit EV to EBITDA. That is, I have assumed to be 24. You enter how much expected returns that you want from your share price. So I want 25% CAGR from the share and number of years, that is 3. Current EBITDA levels are these, and earnings growth rate, but you expect it to be will be 24% CAGR. So like from 288 crores to 540 crores in 3 years, the earning growth rate is around 23.5% CAGR. So the price you should pay today for earning 25% returns with the following assumptions is quadruple 6 crores, 6,666 crores. But currently the business is trading at 4,097 crores, so that's around 26% margin of safety. So this is one test that I use personally, and this is my way of thinking. And as said, investing is an art. Anybody can have their own process for those things. So hence, with current market capitalization, returns can be around 30%. Nobody knows how much it will be in the next 3 years. That is what I am expecting. So there's a note in here also. The PAT growth can be even faster because CDM or pharma in general is a high operating leverage business where you have a lot of depreciation hitting your P&L statement. So the PAT can grow even more from here. So nobody knows what it will be. Only hopeful for the future. Disclaimer: I'm invested in the business, and the video is for education and information purpose. This is not a buy sell recommendation. And next year these are the following updates on the two key starting materials which are in phase 3 and expected to be commercialized in 2027. So these are the management commentaries updates. Q3 FY24, the management stated that it's progressing very well and expected to commercialize in coming years. So here the word was coming years. By the next quarter, they say like that can reach full potential by 2027. In the next quarter, the management says that are progressing very well in phase 3 trials with Innovator companies. These molecules are anticipated to start ramping up by this thing. And in quarter 2 FY25 also, the management says that it's very promising. So that's very good news for us being the investors. Updates on the crop protection CDMO. So there's probably not no update, right? So that's it, guys. You can drop in the comment section whatever more things you want to add so that other people can follow up. And if you like the analysis, hit the like button and subscribe to my channel. And I discuss about different things. This was just a company analysis, and I'll probably come up with different things on my channel. So thank you for staying till here and watching the video till the end. Thank you so much.